A couple of key issues are on the minds of built-for-rent companies and their capital partners. One of them is a reasonable expectation of rent growth. Another is local pipeline and supply, and they relate to one another, right? Part of this is the cost of capital is higher now, which means that bad built-for-rent deals won't work. Last year and the year before that, every built-for-rent deal seemed to work. Everybody was a genius. Now capital is scrutinizing very appropriately every built-for-rent deal. So let's talk about renter incomes and the potential for rent growth. Renter incomes are rising fast as millennials advance in their careers. We just reviewed a study just released by RealPage, and it uses an excellent methodology. It's the only study I know of that's analyzed renter incomes so carefully. What sets it apart is that it compared and captured incomes and rents for the same households, with 7 million individual leases included in the analysis. Other studies have looked at the average income in a market and the average rent, but the two averages are typically based on different groups of respondents. So it's skewed and not very useful. Kind of like the old warning about averages. If you have your hand on a hot stove and the other hand in a bucket of ice, on average, you're just right. You have to be careful with averages. That's why this particular analysis is so powerful. While not specifically looking at built-for-rent or SFR, this data set is about renters, and that is very important to track. Renters' incomes have risen at an annualized pace so far this year of 14% in the first half. And even if you assume the second half is slower, which you should, you're at 11 to 13% for the year. Next year, it slows down even more, but it's still going to be 6 to 8% in the year 2023 by my estimation. And this is important. This came from that study. The rent to income ratio nationwide across all market rate professionally managed apartments is 23.2% versus 33%, which we typically think of as kind of the maximum that a household can afford. And again, it's comparing apples to apples. So it's very important data. The takeaway is that rents, while soft right now, will have room to rise in 2024 and 2025. By then, I'm modeling a 5 to 6% sometimes growth in rent on renewals blended with new leases. That forecast is very much supported by the data on incomes when you're specifically looking at renters. The reason rents are soft and absorption is slowing right now in this fall going into winter is that some people are taking a wait and see attitude. It's about confidence. Although some don't have the luxury of time to hang back. They've got a baby on the way. They've got to make a move, and they have, to a degree, outgrown apartment living, and they need to move to the suburbs, get a place with a yard, and so on. The softness, quote unquote, that's relative to just the blistering pace of 2021 in terms of absorption pace. That softness is not going to persist for very long. The millennials' needs are changing. Some of them are having children. They're outgrowing apartment living. They need to make that move, get into the suburbs, get a yard, get into this good school district, or what have you. Looking at what's going on with rents right now, according to data from CoStar and apartments.com, the data for August 2022 show month-over-month declines in rent in several markets, with large declines in Nashville down 1.1%, Austin down 1%, also declines seen in places like San Francisco and Las Vegas, and also in Orlando, Tampa, San Antonio, and a number of other places. We see this softness resolving itself, and then we'll get back to that 5% plus rent growth going forward starting around 2024. Let's talk about volume. I revised my forecast for built-for-rent volume lower a few months back, and that turned out to be a good move. It was clear that a move towards higher interest rates would push the cost of capital higher, slowing the production pace, kicking out some of those marginal deals. So we will still get to 150,000 units a year of built-for-rent, in my opinion, but it'll be in 2028 instead of 2027 or 2026. It's only 15 to 16% of single-family detached starts. I think that's quite feasible over the next 6 or 7 years. Another big issue is pipeline. How many units are in the under construction inventory in your submarket? How many of those are going to be direct competition? Watch out for Phoenix. It depends on what submarket you're in Huntsville or even Atlanta. In some zip codes in Atlanta, the investor share of recent sales is 60%, but in other zip codes, you're fine. To a large degree, the built for rent stock will not compete directly or will not feel direct competition from the apartments because it does offer something that is different for those people with young families, especially that have outgrown apartment living. Stay tuned. We'll continue to monitor this ever-changing situation in build for rent, and we'll be back with you soon. Take care.